The U.S. versus China economic war, an in-depth analysis. The rivalry between the United States and China is not just about trade, it's a competition for economic dominance, technological leadership, and geopolitical influence. Over the past decade, tensions have escalated through tariffs, sanctions, technology bans, and strategic alliances. Section 1. Origins of the economic war. On trade imbalances and U.S. concerns. For decades, the U.S. has maintained a trade deficit with China, meaning it imports more goods than it exports. Critics argue that China manipulates its currency, offers unfair subsidies, and engages in protectionist policies, making competition harder for U.S. companies. The Made in China 2025 plan, launched by Beijing, aims to make China the world leader in high-tech industries, further alarming Washington. 2. Intellectual property (IP) theft and technology transfer. The U.S. has repeatedly accused China of forcing American companies to share proprietary technology in exchange for market access. According to the Office of the U.S. Trade Representative, USTR, China is responsible for an estimated $300 to $600 billion in annual IP theft. Major cases like Huawei, TikTok, and semiconductor companies highlight the growing technological divide. 3. Geopolitical ambitions and global influence. China's Belt and Road Initiative, BRI, which funds infrastructure projects across Asia, Africa, and Europe, has challenged U.S. dominance. The U.S. counters with sanctions, military alliances, AUKUS, Quad, and technology bans to restrict China's influence. Section 2. Escalation of trade disputes. 1. The trade war begins, 2018-2020. In 2018, President Donald Trump imposed tariffs on Chinese imports, citing unfair trade practices. China retaliated with its own tariffs, particularly targeting U.S. agriculture, energy, and manufacturing sectors. By 2019, over $360 billion worth of Chinese goods were subject to U.S. tariffs, while China imposed duties on a $110 billion worth of U.S. exports. 2. The Phase 1 deal and COVID-19 disruptions. In early 2020, both countries signed a Phase 1 trade agreement, where China pledged to buy $200 billion more in U.S. goods. However, due to the COVID-19 pandemic, supply chain disruptions, and economic slowdown, China failed to meet these purchase targets. 3. Biden's policy. Continuation or change. Under President Joe Biden, tariffs and sanctions remain in place, with additional export bans on semiconductors and AI chips to curb China's technological progress. Section 3. Economic impacts on the United States. 1. Agriculture and manufacturing struggles. Farmers in the Midwest faced severe losses after China imposed 25% tariffs on soybeans, pork, and corn, leading to a decline in exports. The U.S. manufacturing sector, particularly auto and electronics industries, faced higher costs due to rising prices for Chinese imports. 2. Inflation and consumer prices. Tariffs on Chinese goods increased import costs for American businesses and consumers, leading to higher retail prices. Inflation concerns have worsened due to global supply chain disruptions and rising energy costs. 3. Tech industry and supply chain challenges. U.S. tech giants like Apple, Tesla, and Qualcomm rely on Chinese factories for cheap production and assembly. Companies are now shifting production to Vietnam, India, and Mexico to reduce reliance on China. Section 4. Economic impacts on China. 1. Slowdown in Chinese exports. U.S. tariffs have led to a drop in Chinese exports to the U.S., forcing China to look for new trade partners. Southeast Asia and the European Union, EU, have become alternative markets, but they haven't fully replaced U.S. demand. 2. Domestic economic challenges. China's real estate market has suffered, with property giants like Evergrande collapsing under heavy debt. Youth unemployment in China hit record highs, reaching over 20% in 2023 due to weak job creation. 3. Supply chain resilience. China is aggressively investing in self-sufficiency in semiconductor production through companies like SMIC, Semiconductor Manufacturing International Corporation. Government subsidies and R&D investments are aimed at reducing reliance on the West. Section 5. Global impact and economic alliances. 1. Market volatility and investment risks. Stock markets react sharply to trade war developments, with investors adjusting portfolios based on geopolitical risks. Multinational companies face uncertainty over tariffs, regulations, and access to key markets. Section 6. Future outlook. Who will win? 1. Factors favoring the U.S. The U.S. dollar remains the global reserve currency, providing financial stability. The US leads in semiconductors, AI, software, and advanced military technology. A strong startup ecosystem and innovation culture drive long-term economic resilience. 2. Factors favoring China. China has a larger population and labor force, giving it a long-term advantage in production and consumption power. Government-backed industrial policies allow China to fund long-term infrastructure and technology projects. Stronger trade relations with developing nations give China an edge in emerging markets. 3. The likely outcome: coexistence, not victory. Experts predict that neither the US nor China will win outright. Instead, they will enter a phase of economic coexistence and strategic competition. Future battles will likely be fought in AI, semiconductors, space exploration, and military technologies, rather than just trade and tariffs. Conclusion: the US-China economic war is reshaping global trade, technology, and diplomacy. While both nations face significant economic challenges, their strategies, policies, and alliances will determine their positions in the global order. The next 5 to 10 years will be critical in defining the future of global economics and power structures. Thank you for watching this analysis of the US-China economic war. Stay informed on global economics and trade.